All right, we're live. What's up, everybody? Thank you guys for joining the Palantir Weekly Review number 11. We have some awesome special guests today. Emmanuel, you guys know him.
What's up,
Sean,
guys?
Invest Live. Obviously, me and Chris. Their channels are in the description. A lot of news happened this week. Some of it was Palantir related, but I think a lot in terms of the general markets we will go over as well because some crazy stuff happened overall in the general market. So for first, let's start off with this. This week's been bad for anyone who has money in the market, whether you've got $1, 100, or $1,000,000. You're feeling some pain in the market. I want to start off by just getting a gauge on how everyone's feeling. We had a big Teladoc drop. We had growth stocks obviously fell. The QQQ went down 4%. Like it's another growth stock today. Let's start off with Sean. How was your week in the market, and how are you feeling?
Um, yeah, I play the market a little different than most. So I have a lot of married puts and I have a lot of straddles at play. So for me, I'm sort of market indifferent. So I play the market very neutral. Um, it's been good for me from the standpoint of the puts I have in place. It's been good on my straddles. But I will say I share common concerns here that like the overall portfolio is in a position of weakness, right? And so it's hard to deploy capital. That's my biggest challenge is where and how do I deploy capital and how do I now marry up more puts to even make a decision because things are so low. It starts to hit that point where now premiums are really getting too costly for me to make the moves I want to make, and straddles are starting to see huge premiums associated. So that's kind of where I'm at.
Emmanuel, how about you?
Yeah, if I may just ask, I had this huge question. I'll just to ask Sean, how do you buy the dip when you're, I don't know how invested you are, but I assume you're 90% plus invested. So buying the dip, what does that mean for you? How do you buy the dip when you're already almost all in?
I'm like 180% invested. So I've been doing this for a long time. So like I use margin on an almost daily basis to pick up positions that I like and then exit them quickly. So for me to effectively leverage a dip the way that I work, and to be clear, this is not a beginner strategy or for folks who are relatively new to this. I'm looking for intra-week moves within options, right? So I'm looking to grab quick leverage-based movements with limited cash outlays to make those things happen. So that's the way I'm playing it. What I am doing, though, my broader sort of, let's say my holistic life portfolio, I'm adding things as I like them. Like I added some Google. I've been actually, Emmanuel, true story. You and I were on this channel together a couple weeks ago when you were talking about how you YOLO'd into Tesla. You actually kicked off a long string of research for me, and I've been adding Tesla like a madman. And so this week, the price as it's been, I've been picking up a lot. So the way I play it short term is since I don't have direction, I don't feel good about directionality. I use moving averages with short term time frames, and I use those to make my options calls.
Well, what do you mean by moving averages?
Yeah, sure. So within the realm of technical analysis, so I'm primarily an economic based momentum trader. So I'm looking at the economy, the underlying conditions. That's the way that I traditionally invest in trade. But when I'm looking at short term plays, less than a week, less than 2 weeks, I do leverage technical analysis. And the two strategies I use at scale are simple moving averages and exponential moving averages. And the key with the moving average is it helps you to provide a quick understanding of where support is, where resistance is, and where directionality within a position lies. So if you can get good at TA and you can get good at moving averages, it can help you decide and understand near-term directionality. It's really good for long-term, but even short-term, it's not bad. The key difference, I actually just did a really long video on this. I'm not trying to promote it, but if you're interested in it's a really good video for beginners. The key difference is exponential moving averages apply heavy algorithmic weighting to near-term price movements to give you a faster understanding of where prices are likely to go in the near term. So when you see things pop quick, it's usually folks leveraging moving averages near term to make decisions. And oftentimes you can stack with other pieces of research as well.
Interesting, Chris. How is First of all, Chris, do you own some T Doc?
No, actually, I don't.
Okay,
I
so
have
you didn't.
yeah, I have a little bit of Babylon, like maybe a few hundred shares, but nothing major in any of the
Okay.
tech areas. And actually, I'm like really low on how much tech I own, only because the market cycle was starting to switch. So I found that energy was somewhat safe right now. There's like a lot of macro conditions that are playing well for energy, and I mentioned that in our group too. Like, so the strategy that I've been using is staying in energy, which I know right now has huge margins on its way, so its free cash flow is there. So if you have free cash flow, that means that that'll buoy your stock a little bit and keep it somewhat elevated, because at any given time, these companies, if their stock drops too much, they could always do buybacks and other things. And also right now, a lot of people are moving into the yield area. So right now, if you're in bonds, you're losing money because inflation is eating away at your premiums, right? So it's not a good idea to be in bonds. If you're in most stocks, you're also in a bad position, because right now with the rising interest rates, it's almost like acting like gravity, right? Where it's bringing a lot of things down. For energy right now, because of the whole Russia situation, which doesn't look like it's going to be clearing up anytime soon, it gives you a lot of safety to be in energy. So what I've been doing is finding some energy names that a lot of companies have kind of been looking at, especially in the natural gas area, and just selling covered calls. And then what ends up happening is, if I do get assigned that covered call, I made money on not only the premium that I got, but also the rise in price. And then what I end up doing is selling cash covered put on the lower end. So right now, if the company or things change, it'll drop down, but I also have that premium that'll cover me on the way down. So
You do
that's
you
what
do
I've
this
been
on the
using.
day to day? Every
Actually, no, I do it monthly. So I was talking to Sean about it. Some people do options a lot more frequently. Me, I'm more of a monthly options guy. Like I'm traditional. Like traditionally, options have been done on a monthly basis. Weeklies aren't. Weeklies are very risky because the position can move against you or with you very quickly, and also you have this thing called theta decay if you're doing covered calls that could work to your benefit, but it could also put you in a really bad position. So yeah, exactly. It's a wheel option strategy, but I do it on a monthly basis. Especially the companies that I'm looking at, they don't even have weekly options. So sometimes you're kind of forced into doing monthly options on it, but it works out well. I have the money that I've down on Palantir has been pretty much all covered by my gains on the energy side. So I've been fortunate enough to keep myself in somewhat of a better position. But I do have to say, if I see things in this earnings report that lead me back into Palantir, I'm going to trim down some of my energy positions again back into Palantir, especially if it's too good of a deal to pass up. I think I was joking around on our thread today. I said if Palantir drops below 10, like I'm pulling a Sachin and just selling everything and going into Palantir. If it drops below 7, I'm gonna sell my left kidney, and if it drops below 5, that's it. Like I'm
Down the house.
I'll leverage everything to do. But I'm just kidding about that. I'm not gonna do that. But yeah, I think Palantir. It's going to be a slower moving target than most people think. Most people think that it's just going to be one of those up and then wave up. It's going to be harder for it to bounce back. And the other thing I want to kind of bring up too is think of the other opportunities out there. I think a lot of people only look at the company they're fixated on, like Palantir, and saying, well, you know what, Palantir is the only stock that I want, and that's the company that I have 100% bullishness. And I agree, that's a good thing. And I'm just like you guys, I believe in it. But there are other value propositions that are starting to kind of prop up right now that there's going to be capital allocations to that normally might have even gone to Palantir, but won't go to Palantir now. Then say, well, you know what? I could have bought if Amazon is more attractive now, that makes the value proposition of getting into Palantir a lot less. So some people may say, you know what? I was going to allocate more money into Palantir, which is more speculative, but Amazon can provide a better risk and safety profile, and maybe possibly higher gains. So they might shift into Amazon. Or like I said, there's a lot of great companies that have lost tremendous amount of market cap that are much safer plays than Palantir at the current moment, based on what I'm seeing right now. So a lot of that capital may not necessarily go into Palantir right away. So who knows? But I would say right now it's a good idea to be somewhat liquid on your portfolio, so that if an opportunity like that comes where Palantir drops below some really strong support levels around DPO price around 10, might be worth picking up at that time. So
I would just say, Chris, my next move on Palantir, if I make one, is irregardless of the price, if it goes to 6 or even if it goes to 12, it's really about the Q1. So if Q1 gives me some interesting things, growth in client numbers, in revenue, and all kinds of other good signs, then regardless 6 or 12, I might consider adding to my position.
So I just want to mention the one thing that I've been doing on Palantir is DCAing. All right. So I haven't sold anything. I just literally have it set up where I have a fixed dollar amount that I invest continuously. So right now, Palantir is down. So I'm internally, it hurts a little bit seeing my portfolio down, but also I'm celebrating because I'm like, man, I got these shares that are a cheaper price. Right. So a lot of when you're investing, a lot of it is about getting yourself into a strategy where you feel comfortable and that it keeps your mental sanity in check. Like imagine right now if I took in my entire portfolio and dumped it into Palantir and then seeing a 70% drop, I'd have a heart attack, right? But if I'm DCAing into a position which I know is going to eventually benefit me, it's a for me, you
feel the pain more slower, basically.
Yeah, exactly.
The heart attack comes in waves. It's like,
but the thing is, like how I justified it to myself. I said even if the price of Palantir today was at 40, I wouldn't be selling. So if it went to 8, I wouldn't be selling, and if it goes to 40, I wouldn't be selling. So in that perspective, if that's the case for whoever it is, then in that perspective, then it's not. You get less emotional with the day-to-day price and fluctuations. And also I'll answer Amit's actual first question, how's my week going? So Amit, last week, I think, not even long ago, I bought this Cybertruck hat. I bought a Ferrari hat from the Ferrari store. It cost $300.
Wait, hold on. You paid $300 for a hat? Bro, how did the Canadians not tax you enough and get you got that?
We got to see that hat. We got to see that.
I have it. I'll run up and go get it. I'll go get it.
Man, your Tesla earnings must have been. I don't know how much Tesla.
But this is my point. This was like last week when Tesla was at 1,100. So this week we broke 900. I'm like, shit. I'm so freaking poor. And that Ferrari hat just came in this evening. I'm like, this is literally the dumbest purchase I've ever made. I felt so stupid opening that box. Can you
walk us through when you what was the psychology when you pressed buy? Like, why did you do that?
Oh, I figured for these shows, I go, I'll freaking mix up the caps. It's an investment into that.
It's just fun, right? Wow.
Well, I found like shit. It was at 1,100. I'm like, man, I'm such a baller. I'm like, I bought all kinds of junk. I must have bought like 10 different things last week, and now like. I'm the dumbest person around.
Well, speaking of buying things online, let's transition to Amazon and Amazon earnings. We'll talk about Teladoc in a little bit. Let's go to Amazon first. It brought the whole market down today. I mean, it was bad yesterday, but near 1 o'clock today, I guess Amazon really started hitting the market. Sean, what were your thoughts on their earnings, and what are your general thoughts going forward now that Amazon took the market down? Is there a world in which we recover?
I have zero concerns with anything that's going on. There's not a single stock you're going to bring up right now, except maybe a few. But for the most part, this is a market-based move. Everyone is going to have earnings issues right now. Okay, we are coming out of such a strong period of time that this is cyclical downtrends. This is extremely normal for long-term investors. These are the opportunities people talk about 20 years later when they say, man, if only I was in the market when those prices went down. And I think that the people who are talking right now and everyone who watches this are in that same group of those who are just generally looking and saying, look, things are down everywhere. There's a crisis and a war happening. We're seeing general inflation. This is the natural state of the way things have to correct themselves. It's not a moment for being upset or concerned. And let me, just to jump into the Amazon piece. Is Amazon reflective of the overall economy? 100%. Sure. But we're not getting a true picture on this, right? There's probably 90 Amazon trucks that go by my house a day, right? I live and breathe inside of AWS basically with almost every customer I talk to all day long. They have the most dominant cloud on earth, the easiest to use, from affordable to complex to extremely curated and perfectly designed. I mean, I'm looking for the right word. No one is going to stop using Amazon. Prime is crushing it. They have great technology across the board. I mean, their split up value is enormous, right? So for me, that's a fundamental understanding of how we look at a company in the first place is what's their value if you were to split it up. AWS alone is one of the biggest companies on earth, full stop. I mean, the amount of companies that we talk about that run on AWS, the Fortune 500 runs on AWS.
All the streaming platforms use AWS except YouTube. So
of course,
all of our content is streamed through AWS.
Yep. So am I concerned? No. I picked up some Amazon this week. Admittedly, not a lot. No calls. I just grabbed some equity. It's the kind of position that at this price, you can't go heavy all at once. So the more you can Chris, you nailed it a minute ago. Amazon's a perfect DCA for me, where it's like, I didn't think I'd see it at this price. I actually almost can't believe I'm seeing it at this price. So I have no concerns. I'll tell you guys like just a really quick 30-second story. I can remember sitting at my desk. I was working in finance in the time in 2008, watching as everything was falling apart live. This is a true story. I watched the stock for Citigroup drop to 99 cents. I put my entire retirement at the time. I was much younger guy back then. I watched that thing hit the price of an Arizona iced tea, and I went in that like everything I had, I liquidated to buy that. And I'll let you look up where it is today. And there's been some splits and stuff, but
I'm literally pulling it up right now.
Yep.
So this was you right there, right? You said 2008. Yeah.
Yep.
So it was over there, 2007. So when it had that drop, that's when you started buying it.
Yeah, but keep in mind now. So what they did is they did a reverse split.
They did split. Yeah, they split.
Yeah. So the chart's not as accurate as you might think. But the only reason I share this is there are moments in time when you're going to think back and you're going to say, "Holy moly!" You grabbed Palantir at 10, or you grabbed Tesla at 800, or you grabbed Amazon at, what is it, 2,300 right now, whatever it is. These are the moments where investors with long-term vision can stand back and say to themselves, wow, I had a shot, I took it, and I got in. And part of this is being well-balanced in your approach, not going all in bananas on things you don't understand. But what I said to myself at that time, and I think everyone who watches this needs to do this as well, the market cap of Citigroup after that crash was worth less than just its real estate. Forget about its business, AUM, everything. And that's the same approach I do now. What is that, 14 years later? So, I don't stress over it. I think Amazon's an amazing company with unbelievably talented leadership, by the way. That's a key thing here. This isn't some fly-by-night silliness. This is an extremely well-run technology and logistics company at scale with best-in-class B2B commerce, best-in-class technology to run on, and best-in-class last-mile delivery systems built into place. I mean, it's hard for me to see anyone eating their lunch, and I'll leave it at that.
Chris, what do you think of Amazon earnings, and do you kind of resonate with Sean of just like there really is zero emotional sadness you should feel? It should be all upside and excitement if you do believe that the company will be around a decade from now and will still be killing it.
Yeah, I agree with that. I think Sean was actually really right about Amazon. But the one thing that I will probably say about a lot of the FANG names is that now think of them as blue chip value companies, and they should be measured as such.
You really think they're value companies?
No. Let me say the growth rates have significantly come down from where they were previously. All right, which means that they're not bad companies to invest in, except if you're looking for a 40-50% revenue growth, you're not going to see it. I don't think Amazon can generate that being where it is right now. There's other companies that, because of their smaller size and smaller scale, they're able to grow much faster. So Amazon is in my portfolio, but it's not in my growth portfolio anymore. It's in my value portfolio now. So that's how I would try to value a lot of these big name companies. I'm not saying that they don't have value. Every company has its own intrinsic value behind it. The question is, what are you basing it on? Do you think Amazon is a growth company that's still got tremendous room for growth, where you're going to see a 40-50% growth rate for the next 10 years? No, of course not. Palantir does. So Palantir is my growth company. Amazon is my value company, and my portfolio is somewhat heavier towards growth. But there's also a segment, especially in my retirement fund, which is more secure for me, that I'm going to be buying stocks like Amazon in. In my day-to-day portfolio, I'm going to be doing things like Palantir. So that's the one thing that I think a lot of people messed up on over the last couple of years, where they were valuing a lot of big name companies as growth stocks, because they're like, oh, well, this growth is endless. It'll always grow this fast. Like, no, what ends up happening is you have to look at it from an S-curve perspective, where you have that slow trickle up, then you have that huge rise, and then guess what? You still have growth, but it's going to be at the top end of that S-curve. I think Amazon right now is hit at the top point, where now it's still growing, but it's growing much slower than before, whereas companies like Palantir haven't even hit that trajectory of going super growth yet. So that's what I would say. And like I said, Amazon needs to consider a dividend.
Yeah, Kelly says Amazon dividend. I don't know, Sean, your thoughts on that?
Actually, Kelly, you read my mind. I wasn't even sure if I was going to make that comment or not, but I'm going to be totally honest with you. I think a lot of these big tech, when Apple first announced they were moving to a dividend model, granted it's not huge, that was a huge bonus for long-term shareholders. And I think for those who accumulate and hold Amazon for the long term will be rewarded in time, not yet, but in time with a dividend. And I think, Kelly, it's a great call out because that's spot on. That's my opinion, of course, too. But I think it's eventually going to be a no-brainer because people are going to start. What's going to happen is the market's going to start demanding for separated AWS numbers and recognition for the growth within AWS. And the way you're going to get it to keep it happy is to deliver some sort of a return to shareholders. And buybacks are great, but dividends are better for the retail investor typically.
Manuel, your thoughts on Amazon?
Well, we'll comment. Is it true that the main reason they went down was because of the Rivian loss, the paper loss on the Rivian investment? Was that the only negative catalyst to the price?
That and the retail business was slowing down. I think that was the two core things.
Retail as well. And
it's just hard to keep repeating that retail number. You know, I mean, how much more can you sell, especially if you have a supply chain crisis? That's the one thing that I don't understand why CNBC wasn't reporting. Like, you do understand that Amazon can't sell things that it can't get, right? Like, there are supply chain issues. So if you're trying to find a product and Amazon doesn't have it, because guess what? There's a supply chain issue. People are not going to buy it. So yeah, of course that should be factored in, but I don't know.
But a question for Chris and Sean. So you're mentioning that Amazon's going to have slower growth because they're already at the top of the S curve. But is there a possibility that since a company is so big that it's easy for them to acquire other companies or other methods of growth to continue their growth? Like a $1 trillion company, can they get to 10 trillion because they're so big?
Yeah, Amazon's only at 1 trillion, but that's why when you said it was value, I'm like, or 1.5 trillion. Apple's at 3 trillion. I'm like, you know, obviously it's not going to 10x, but like 3-4x is still, I don't know if that's just value, you know? That seems like growth to me.
The short answer is like, I think, yeah, they can certainly acquire, but acquisitions are a costly game to purchase revenue. It is the game it is the game to play, but it's not at the rate of margins that people often want to see. So you get top line growth, but you will oftentimes see bottom line constriction because you're paying premiums to acquire the companies. You have integration costs. You have tech stacks that don't match. You have new teams to integrate with technology. And we see this across a lot of these folks out there. That said, yeah, that's going to be the play for sure. I also think that we are currently sitting in a political environment where M&A is very tough to do right now unless you want to get obliterated publicly. And Bezos being Bezos, he is likely to be the poster boy for getting lit up for everything he does. I mean, having phallic rocket ships is not the best decision either. I'm going to put one up there, but that's a conversation for another day.
Yeah, and the cost of capital is also another thing that's going to prevent a lot of companies from doing M&A. M&A before, if you had really low interest rates, you could issue a whole bunch of debt. So guess what? You issued a bunch of debt. You were able to acquire revenue using that debt. Well, now the debt levels are increasing, and now the uncertainty of refinancing will also preclude you from doing further M&A. Because let's say I was able to get a short-term 5-year, you know, do an unsecured or even a secured, bond issue. One, the bond like buyers are going to be wanting a higher yield because number one, you know, interest rates are higher. So, and the other thing is the risk of inflation is there. So a lot of them are even asking for on top of what inflation is. Otherwise, they're nominally going to be losing money. So what you could have issued at, let's say, an 8% coupon a year ago, just to, you know, do capital financing on a big project, right now investors might be demanding 10 plus collateral on top of it. So, and then you have closing costs, you have all these other bond issuance costs. So right now, M&A is probably going to sink a lot more than what people are used to. The other thing is Amazon, even if it wanted to do acquisitions, who would they acquire? Like, they're such a big fish right now that even if they were to acquire a company, like, it'd be small, really small fishes that wouldn't really get you much. Like, you have to remember when you do an acquisition, you're trying to either do one of two reasons. One, you're trying to buy growth, right? Because that company might be growing really fast. You might be growing a little bit slower. So I was explaining last time, Salesforce, Salesforce is great at growing and they consistently grow, but what ends up happening is they acquire companies that are growing even faster than them. And then this way, even if their one business is slowing down, that acquired company's growth will end up averaging them back to a point where, you can see that reliable trend up. So that's one. And two, there's a gap in your business that this other company could possibly fill, right? So if you're trying to do e-commerce, guess what? And you have terrible logistics, either you could do one of two things. You could try to turn around your logistics business or develop a logistics business, or you could just buy a logistics business. So that's what Alibaba did. Alibaba just bought a whole bunch of logistics providers in China because it didn't have that core infrastructure for themselves. So it was a choice. So a lot of companies are going to have to decide right now, like, do I either try to develop something myself or do I buy them out? And so I don't know, like, it's going to be the same question that's going to be propositioned by a lot of automakers with this charging infrastructure companies, because they're going to say, well, do I try to make my own Tesla-like charging stations around the entire country, or do I just invest in Blink Auto, or not Blink Auto, what is it, Blink Charging, or Electrify America, or just partner with them? So, it's a crapshoot how M&A is going to do. But Amazon, I don't think, has any targets in mind in terms of like for them. So
it's easy to look at Amazon from 1,000 feet away and talk about all the things they should be doing. This is an incredibly well-run company that has a great trajectory. It has almost no competition whatsoever in multiple categories, right? They're a market leader in practically everything they do, or second place at worst. So, I would just simply, in my personal opinion, that's where I would leave it there, is that I think what they're doing at this point is refining what they have, looking for new avenues to take it. And for a company like Amazon AWS, one of the biggest challenges is getting talent in the first place. So a lot of times what you see is acquisitions for talent. I don't think people talk about that a lot because if you don't work in tech, you don't see it. But it's hard to find talented teams, from sales to marketing to data scientists. It's not as easy as people think, and the costs are very high. So there's good reasons to look at good companies because they have great teams too. So just a consideration. It's not just about top and bottom line.
All those people are going to Tesla, SpaceX, and Palantir.
Yeah, or a lot of Web3 crypto startups. I mean, it's really hard to.
Yeah, they're looking for that upside from the get-go.
Okay, we're moving on. Shout out to 145 people in the chat. Definitely check out everyone who's linked in the description. Give them a follow, give them a subscribe. Check out some of their content. Sean just did an awesome video on margins. We got to talk about Teladoc, and I think we should hear straight from the person who believes in Teladoc. I don't know if everyone's seen this yet, but I think it's worth 3 minutes of giving
Cathie,
it a watch of Cathie. So here's 3 minutes of her defending T-Doc, and then we'll give our thoughts. Everyone can see it, right? Yes? Okay, cool. I'm going to do full screen.
Joining me now is Cathie Wood, the CEO and CIO of ARK's owner, ARK Invest. Cathie, welcome. We all give you credit for coming on to talk about why in the world you bought $20 million more of T-Doc yesterday, right?
Sure. Hi, Kelly. And yes, I'd much prefer to come out at this time than to come out and be all over media when things are when stocks are soaring, because I think this is our best value add. Yes, Teladoc, very, very tough quarter. And that's particularly for investors who are quarter-to-quarter oriented. As you know, we have a 5-year investment time horizon, but as fears about inflation and interest rates have moved up, time horizons in the market have shortened to basically a quarter. And so the analysts picked apart the quarter.
Hey, Amit, can you mute your mic?
On the direct-to-consumer business, which did have a shortfall. There's more competition in that space as venture capital is financing some companies who are getting into niche areas. Now, our point of view is that Teladoc is becoming the healthcare information backbone of the United States. It serves 16% of Americans are paid users. And whenever we look at S-curves, we are looking for that 15 to 20% range as a trend moves into that market share. That is the beginning of an S curve. And the story is not direct to consumer for Teladoc. Certainly that was a big booster during COVID. The story here is much bigger. It's business to business. What was not mentioned, and no questions about Northwell, the New York or tri-state area hospital system that Teladoc has won, took it from another entity. And what was also not mentioned is Amazon's decision to partner with Teladoc as opposed to compete with it. The stock had been beaten up regularly over the last year as Amazon said, we're going national. And instead, Amazon has capitulated and at least is going to partner for some healthcare services and certainly through Alexa with Teladoc.
Sure.
So I think the story here is huge. When you think about healthcare as 20% of the U.S. economy, so a $4 trillion ecosystem, the waste there is at least $400 billion.
Sure.
We would say most of because this healthcare information system connecting patients, doctors, insurance companies, and hospitals has not been put in place. This is a winner-take-most market, and we feel that yes, short term there was an earnings shortfall. They had to cut estimates. Admit that. We're looking 5 years out. We're looking at one of the biggest stories in healthcare, a category killer during the next 5 to 10 years.
Sean, we'll start with you. What are your thoughts?
Come on. Like CNBC, is there only one person on the planet you can possibly interview? And they always make it out like it's some genius level preponderance of information on every time Cathie's on. Look, I don't know Cathie. I have no beef with the lady. I don't care what she does. But everything she says is like well-known facts that anyone who's even new can recognize. Is the future of healthcare changing? Yes. Is Teladoc likely to be a player? Yes. Did you still find a way to lose money on that even still? Yes. I'll give you a great example. I use telemedicine all the time. And let me tell you how easy it is. I go to CVS. It's covered by my insurance. I set up an appointment in 3 minutes. Right through CVS Minute Clinic, I can meet with the doctor online and get whatever I need. And what I've been doing is, actually, I'll give you guys another, I do this all the time when I talk to guys. I make a big deal about due diligence. I won't go too deep on this right now. Like you know the level of due diligence I do on companies. I started scheduling and meeting on these services, and what I've been asking the doctors is what percentage of your patients can be handled online versus in person? And every one of them is like 90+%. Like very rarely do we really need someone in for a first visit to come in who's sick anyways and even take them out of their house. I don't think there's anyone who's disagreeing that the future is a virtual experience. It's not even a debate. I think what's laughable is his continued push of like, it's 5 years. Teladoc's a great company in theory. They've got to get their stuff together, which clearly they didn't. It's embarrassing to think that they missed because it's a predictable business. That's what bothers me here. It's not the company. It's not the technology. It's that they couldn't even predict their own numbers for a predictable business. That's what bothers me. What bothers me more is the person who keeps pushing these can't seem to do it either. I'll leave it at that. Like CNBC drives so hard to get the same exact two people on every single day. And it's like there's no variance in opinion. We just make it seem like losing money on a regular basis is somehow a genius move to then buy it lower. And I want to be clear about one thing, and I'll literally go on mute. Her buying 20 million of T-Doc, doesn't she already own $1 billion worth?
Well, she owns, yeah.
That's like finding a $20 bill in the street and being like, well, I'm a millionaire. It's like, well, yeah, because you already had $1 million. You just found a $20 bill. You know, I mean, it's silly. What they didn't say in there was that she had $1 billion already. They said she bought 20 million. I mean, it's like, come on, it's silly. Everybody knows it's a great company.
But Sean, I don't feel that CNBC paints Cathie in a genius light. I feel when she comes on, they're like, Cathie, explain it to us because we don't get your position.
So I'll give you my explanation for it. if you're an investor who's relatively new and CNBC is the channel you watch, which most retail investors watch CNBC, and you see the same person every day, who also, by the way, is marketing her own fund to get paid on the AUM you give her. That to me is the problem, is that it starts to feel like there's no other options to invest your money, because Cathie must be the one to put it with, because she seems like she knows what she's talking about. That's my beef, is that it's more like a marketing ploy than it's a true discovery of new information on what to be looking at as an investor who wants to have an option. It's never, my point, Emmanuel, is they didn't bring another person on to say why she's wrong. Mm-hmm. They just let her say why she's right, while continuously being wrong, by the way.
Yeah, Emmanuel, what were your thoughts on T-Doc's fall? I don't know if you have any crazy opinions on this.
Well, no, just one thing that I'll bring to light. What I understood was that their purchase of Livongo, which they did 2 years ago,
yes,
was severely overpriced.
So they purchased Livongo for $18 billion. For those who don't know, Livongo is a hardware medical company that makes devices that doctors can use virtually. So they can basically check your blood pressure using Livongo's hardware virtually, which is really cool, right? Like that's like some really, really crazy stuff. Obviously, Teladoc was like, oh, if we get that, we can really conduct everything virtually. It's $18 billion. Now that is worth 14% of what they paid. So they paid a 700% premium, and they wrote off $6.6 billion as not a loss, but just kind of like, it's called a goodwill impairment in accounting. And basically the asset that they bought is lost $6.6 billion of value, which basically made investors feel like they completely mishandled the acquisition and they can't trust management anymore.
So I'm going to disagree on that one. And I'll tell you why I disagree with it. They bought Livongo with their own overvalued shares. Okay? You have to remember, the company that they bought, they didn't just buy it and say, okay, you know what, here's all $18 billion in cash. A lot of these companies, even Zoom tried it when they were trying to do some acquisitions, because they knew their stock price was way too high. Even a lot of CEOs, they can't come out onto CNBC and say, hey, don't buy our stock at 300, it's overvalued, right? Mm-hmm. So guess what they do? They're like, you know what, we needed to purchase something that we didn't have. Our stock is overvalued. So even if they overpaid for Livongo, they didn't really overpay by much, because most of it was issued by shares. Yes, it was still overpaid. Don't get me wrong. It's still overpaid. But a lot of people are thinking that Teladoc's management is retarded for paying $18 billion. No, Livongo is actually kind of stupid, because Livongo has better growth prospects and they were able to sell out. But even Livongo is like, yeah, I guess, you know what, if someone's willing to pay us $18 billion, exactly, why not take it, right? So it's I think a lot of people, they tend to think that, you know, all decisions where you have to take these impairment charges, you know who's stupid? The people who actually were buying Teladoc at 300, at 200 something, like Cathie Wood, right? Like, how are you valuing this business even with that acquisition? Do you really think that they're worth $38 billion? Because that's what the total merger Livongo plus Teladoc was at that point, and they were generating less than, I think, $1 billion in revenue a year at the time. So that's the question that you should be asking, like, hey, where is Cathie Wood's risk control in her brain to say, look, the value of what I'm buying, I'm not going to be able to justify this unless Teladoc grows at a very high rate for a lot of years. Now, the value proposition for Teladoc, in my opinion, is starting to get better. It's still not there for me to say, hey, I'm going to buy some Teladoc. I think there's still some pain that's coming on the way. But just like Sean said, this is a market where a lot of people have sold out of really good names that have really good partnerships, that have good technology. And one of the things that we're starting to see, and I work in healthcare, is telemedicine becoming a much bigger player in the U.S. economy, which that part is 100% true. What she said is 100% true. The thing is Teladoc the only company that's going to, you know, go to the moon? I don't know.
But they have to be right on that to put a Billy in there, right? Like they cannot be wrong on that. And that's the problem right there, that you just nailed it, which is, how do you invest that much money into it? You know, and are there other players? The one thing I never hear from Cathie Wood, how come you didn't buy any of the other telehealth companies?
How come you didn't buy Amwell? How come you didn't buy Babylon Health? You know, they've got growth prospects too. They're in that industry that you think is going to grow. Like, I
Okay, so
really want to know.
Let me pose the question to you and Sean. Sean, let's see if you can put some insight here. Are the researchers at ARK too young? Because that's a big. They hire like these fresh, bright minds, they're all public on Twitter. Like, they got Tesla right, and Wright's law. I mean, definitely the old hedge funds would never have thought of Wright's law in 2016. So that's correct. But are they too clouded by their own bias to make billion-dollar bets on these companies that, like Robinhood, that probably shouldn't be worth that?
Most of these guys that they have never gone through a real downtrend. If you're hiring too young of a people, they have no idea how to do risk management, how to actually value things correctly. They've only seen bull markets and think that things are just going to be bullish. One of the reasons why you hire old seasoned bears that have taken a lot of hits over multiple years and over a lot of market cycles is because they understand what the cost of being wrong is. A lot of these young guys that Cathie Wood has hired that will probably end up being fired because they can't manage to eke out a gain. Well, guess what? They're probably going to make the best investors 20 years from now because they're like, yeah, I dealt with this bullshit in 2020, 22. I know not to freaking go all in on a company just because, telehealth is the next big thing. So let me buy the biggest player for fucking no reason at a very elevated price. I'm being serious. Every good investor has gone through periods of downtrends. Any real investor has gone through their stories. Sean is going to tell us about his biggest losses because that's how you can get credibility, Sean. Ask me about my losers. I have plenty of losers that I know and which have saved me from making mistakes in the future.
Remember 4 weeks ago, Sachin literally coughed up his lungs talking about his worst loss. Like, it was bad.
But Chris, sorry, Sean, I'm just going to jump in 1 second.
Please.
The analysts at ARK, Chris, okay, the ones we see, they're young, fine. But those are just the analysts. I don't know. Are those guys? They have a big team. ARK. If you check their website, and they, for example, worst case, they have Cathie there to oversee them, and she's like in her 60s. So I don't think the analyst Tasha Keeney, I don't think she's the ones making the necessary day-to-day trades. So I don't know if we could blame ARK's
the analysts
failures on the young ones.
The analysts pick the stocks, right?
Yeah, well, I'm sure they do their research, and then I'm sure they have big group meetings with like the 10 other
with the Queen, Cathie, and then she's got
with Queen and 10 other older people as well. So I don't know if it's fair to like blame Tasha Keeney and Brett Winton on the
Brett Wonton.
On the
Brett Wonton, the guy who can't even do a podcast in a room when he's on Meet Kevin explaining why he sold Palantir. Wonton, that dude.
Yeah.
Come on, man. Come on, man. All of their stocks are down. Roku, Coin, all this shit is down. Like, to me, and again, maybe it'll come back up. But you can't go out there and say 5-year time horizon and then sell like, that's why I think it's bullshit. I'm like, what the fuck? What do you mean 5-year time horizon? You sold Palantir after less than a year. Don't give me this 5-year bullshit. Like,
let me ask Sean a question. Sean, is it possible that people, big time managers like Warren Buffett, like Cathie, referring to the question that they said, why Teladoc and not other telemedicine, is it possible that they have outside influence from others, other fund managers or other multimillionaires that are saying, hey, Cathie, telemedicine's great. Make sure you buy Teladoc and not the other ones.
So let's separate something for a second here that I think is really important for people to understand. Before I'm going to answer the question in line here. In 2008, there were several Cathie Woods that are gone now. In 2001, there were several Cathie Woods who are gone now. They don't survive the bear markets because they build funds for bull markets. Right? When you build funds for innovation only, what's the worst thing to get hit? It's innovation when things don't work your way. So here's the problem with the design of ARK is it is nothing more than an ETF. Okay? It is not a hedge fund. It's not a private equity fund. It's not a private capital fund. She has one option. I have to hold stocks long. And because of the size of the money she's deploying, she can only really buy certain size companies. Otherwise, she moves the market too much and has to overpay for her shares. Even with dark pool investing, and if I can explain what that is if people don't understand, when she's buying and she's buying publicly, she has to tell people what she's doing. They make money only on AUM, period. And they do charge more than a lot of other funds, but the expectation is you're going to get that growth because of the research. When the four of us, anyone who's watching, you don't buy ARK because you want to own the shares that they own. You can do that yourself. You're paying them a fee whether you know it or not. You're paying them a fee because they're supposed to have the best-in-class due diligence and research on what they're investing in. The problem is once you get to a certain size, I don't know if anyone here has ever been in the hedge fund industry. In the world of funds, you have to know what your sweet spot is. Some funds only want $100 million max. They don't want anything more than that. Some want $1 billion, some want 10. And it has to do with the way they deploy their capital, the size of the markets they deploy into. Cathie is a massive publicly traded ETF fund that has to invest in companies that can take, Teladoc has to have $1 billion worth of shares to be bought. Otherwise, she's going to corner the market and destroy volatility and overpay for it or crash it when it sells, right? So there's considerations at play. Not that there's people pressuring her. That's not the case. They have to be able to get into companies that are both big enough to have room to grow once they put their capital in and survive downtrends. It's a much more complex thing when you're trying to build a fund based this size than it is just picking stocks and putting them in your portfolio. I want to make only one more comment and I'll be quiet again. I have no beef with Harvard MBAs who know how to leverage every kind of analysis and DCF and technical tool in the pockets. They're great at that. But I'll tell you what, how many of them are calling doctors on Minute Clinic? How many of them are walking into 35 Dunkin' Donuts to confirm how many people came in for lunch that day? That's what small funds, good seasoned investors who've been doing it for 30 years do, right? To your point, Amit, you can come out of school with straight A pluses and an MBA saying that you're the best analyzer of a company of all time, but just financial analysis, just economic analysis.
Facts.
There's so much more to consider to get in front of a trend. And that's the problem that sometimes gets missed by these massive funds, which is why, to be fair, the proper design of an ARK is just to slightly beat the S&P. That should be their goal. People are looking at ARK like it's a hedge fund deploying secret money all over the planet. It's just an ETF with a cool name. That's it. It's just an ETF, guys. Like, there's a million people who do it better. I'm sorry to say it's the truth, and I know I'm going to get hate for that, but like, it's an ETF. Come on. That's what I got to say about that. So,
Amit, would you let me just jump in a couple of things? Sorry, bro. I'm monopolizing the question.
No,
One thing I just want to pull out about Cathie, in October, Zillow tanked as well. And Zillow was a huge position of theirs, if I remember correctly, in their top 5. And I was like, I figured they had some inside information, inside research, like you were saying. Like, did they do the research that the home buying, the iBuying was trash? Like, how did they miss that? How the heck did they miss that? They have all these analysts, they have this huge team, and there's Zillow, there's Redfin, there's Open Door, and they only had Zillow. Oh, then they had a bit of Open Door actually, but mainly Zillow. And I'm like, well, shit, they chose it for a reason. It's a big position. I'm assuming they know some inside stuff and they did a bunch of research, but obviously they didn't. Then secondly, it's so funny that I'm still not ready to hate on Cathie. I'm still like a huge fanboy, but when Jim Cramer said close your fund, he told her that like 6 months ago or whatever. Close it. So now what are we saying? Like, Cramer was right? And like, we were all smashing him back then when he was like, Cathie Wood, close your fund, which she said made no sense. But so maybe Cramer is like the good guy in all this. That's crazy to think. And then let me ask you this. What was she supposed to do in February 2021 with the highs when Teladoc was almost at 300?
Was she allowed to just sell everything and be like, guys, I got you?
What should she have done? Exactly.
Or was this inevitable? Or did she have to mitigate by like having hedging? But she can't hedge, right? Like,
she cannot hedge. And I have not personally, Chris, I'm sorry, I'm dominating. I'll let you go in a second. I haven't personally read the prospectus for the ARK funds, but my guess is they have to call it out as part of an SLA agreement within there with fund holders that they must maintain a certain percentage of always being in equities, which creates a challenge for a growth in innovation growth fund. Is when you're at the peaks, that's a big problem. There's another industry, if anyone ever feels like doing the work on their own, that will really teach you about this. Look at how private equity fails during all-time highs. Their challenge is they have to continuously find new returns at all-time peaks, and this is why there's an ebb and flow of bankruptcies within PE as well. You just don't normally see it in the ETF world because there's always retail investors to throw their money at those problems. Whereas private accredited investors will pump the brakes and say, I'm not putting another dollar into a bad investment. Retail watches CNBC, hears how smart Cathie is and the great decisions she's making as she stutters through her conversation, and then doesn't understand why it goes down.
But could she have sold like a lot of her stocks at that time, or no? It's just like she can't sell those.
She can sell them, but she has to replace them. That's what I'm saying. Within the prospectus, we'll call out what percentage of capital has to be deployed and how often and what kind of, like, those are things that get called out typically.
So let's say she's real quick. Let's say she sold a shit ton of Teladoc at 300 and she bought like Google or like she could have done that, but that would go against the prospectus, right? Of the fund.
Well, yeah.
Correct.
Also,
I just want to call out too, because I think maybe there's some confusion. I'm trying to keep up with the comments. As usual, someone on here is telling me I don't know what I'm talking about. So it says here that an ETF is not a hedge fund. I agree, as I simply stated a moment ago, an ETF is in fact not a hedge fund. A hedge fund can go long, short, neutral. They can leverage all kinds of strategies across any market, any sector, anywhere in the world. Full stop, period, their decision. A hedge fund can buy lottery tickets if they feel like it's a good investment. They can buy Beanie Babies and Pogs, okay? An ETF has a structured prospectus that's released publicly, which is why retail traders are allowed to be invested in them. A hedge fund does not follow those same rules. I just want to call that out. If there is confusion there, 100% an ETF is not a hedge fund. Could not be more different, completely different thing. Just want to be clear, and I'm sorry for jumping in, guys.
You made that clear before.
Yeah, and the other thing is she can't even go into like areas of safety because her entire thing is based on innovation. Let's say she went into utilities. You can't be running an innovation-based fund and buying utilities, but guess what? Utilities are going to outperform in a higher interest rate market. So
wait, but why can't she? Why can't she? Why can't she just come out with a tweet that says, "Hey guys, we think this is the right time to buy utilities"?
Dude, if she started buying PG&E, like, and she's saying I'm in an innovation fund, dude, everyone who's a real investor at the time would have just dropped it and said, "Screw this." She's lost her mind. There's no way that PG&E can, like, utility companies aren't innovative. It's just not an innovative thing. And not to mention, they don't grow that fast. She actually comes out and says, we're going to grow at 20% every year. We're going to grow at 50%. Find me one utility company that's going to grow 20% a year. Guaranteed, I guarantee. That has never happened in the history of the world, right? But guess what? There is no utility company that has gone down 20% in 1 year also, because they have a business that has reoccurring revenue that's very safe, unless there's like circumstances where the utility company is held liable for something really bad, like the California wildfires or something like that. So if there's like a huge macro level event, utility takes a hit. But other than that, utility companies are just like, like most of the time they're like a little bit of growth. So there's a lot of companies, even on the equity side, that a PE fund can just go into and say, you know what? I'm out of growth name tech. I'm into value. I see there's value here. Let me dump some capital on that side. Sell my growth names, buy into value. She can't do that.
But she said she was doing that in the past. She said she had cash-like positions, which were Apple, for example, and the Regeneron. And then even Kramer was laughing at her. He's like, "Oh, Regeneron, is that a cash position?" Or I think it was that. Anywho, that's what she said. She said she buys more stocks when things are high to diversify, and then when things are worse, she'll concentrate on her.
She also says that she goes into higher quality names, but every high quality names that she's been getting into has seen dramatic drops. So I don't know. I don't know what's going on. Yeah, I mean, for me, every fund manager has their canary in the coal mine in terms of, like, for me, when I look at it, for me, it was Berkeley Lights. So last year when I saw them doubling down in their Berkeley Lights position, especially after a short report came out that had very credible evidence that, hey, this company was actually running a really big, like, like a really, I wouldn't call it fraud, but they were literally had all sorts of copyright infringement issues. They weren't selling products. This short report was very detailed. And one of the things that I know a lot of people don't like shorts, right? Like, a lot of people are like, oh my God, I want them to burn. Berkeley Lights, yeah, it's down, 98%? Like,
bruh.
Yeah.
Oh shit,
and guess what?
You're right, 95%. Holy.
And she was buying the entire time. Look at what she bought it at. Go to
I remember that.
Go to, what is that thing called? Cathie's ARK, and look up Berkeley Lights, right? That short report, shorts, they do so much detailed research that, trust me, if you're investing in a company just because it's shorted, you better be really, really strong with your conviction, because a lot of these short funds, they do tremendous amounts of research. They pay tremendous amounts of money to get research that's not even available to us as retail investors. These are the companies that will hire satellite companies to take photos of parking lots over 2-year period and then have someone literally count out how many cars there were in the parking lot to get an idea for how this business is actually operating. And I know a lot of people are like, oh my God, are you like fighting for the shorts? No, but shorts have also been responsible for, guess what? Finding the Enron issue, finding Luckin Coffee, which literally were frauds. So all I would say is for her, when she saw that short report, she should have taken it seriously. I didn't hear anything about it, and she kept doubling down. I was like, dude, I'm out of here. So I had a little bit of a position in ARK. I Van Moose the hell out of it.
Just one quick comment too, and I think as more and more people become more experienced investors and have more time in the markets, there's more things you start to look at as an investor. So Matt Money, who by the way I actually look at a lot of his stuff too. Now Matt is correct here, but the problem with this statement is not that Matt's wrong. The problem is things like the Sharpe ratio and Sortino ratio. For a real investor with significant amount of capital, I need to understand volatility, risk, upside, and downside, and make sure that that's worth the risk that I'm taking on by investing in a growth fund or an innovation style ETF, which it's just the name she's using. But my point, I'm looking, if I want something with, humongous volatility, is this really the best thing for me to buy? I don't know. Those are sort of the other kinds of things I'm looking here, is whether or not it just matched the portfolio of something else or not. Like, look at that. I mean, the problem with this is, depending on when you buy, depends on when cataclysmically you've lost all of your money and go bankrupt. It's a scary thought for an ETF that's widely accepted and adopted globally, and also marketed nonstop on CNBC.
Yeah, ARK did 100%. SPY did, SPY did 100%. ARK did 90%. Or so ARK did 100. SPY did 90. I think Berkshire did 80. If I'm wrong, Berkshire did 100. ARK did 80. SPY did 90. Something like that. I was hearing it today. But yeah, I mean, dramatically different results to get to the same point. And this is where, if you bought here, you're screwed, right? Whereas if you bought here in SPY, you're doing all right. So I guess the question is, does she come back? Do you guys think in the next 5 years, ARK actually makes a comeback? Comeback as in Robinhood works out, one of these becomes the next Tesla, and like ARK, this truly was just a blip in ARK's history, and 2027, we're all like, damn, why didn't we buy ARK when it was $40?
Just for the record, let's step back for a second and understand that ARK is a family of funds. And within the family of funds are different funds, right? ARK Genomics, ARK Innovation, ARK FinTech, whatever it is. I don't know all the different ones that she has. I'm not invested in them. But yeah, sure. I think that if she just eventually gets a couple of decent positions and the market does have a big jump or there's some really good earnings, yeah, surely she will. The problem is she's taking and raking in tons of fees right now while massively underperforming. That is a question then of like, how much better would you, the investor, be doing in something else then? Would just sitting in SPY and reinvesting dividends be the better play for you? I think for some investors, maybe it is. I don't know. I mean, I think anyone can make a comeback, but if you're allowed to be on CNBC 5 days a week and talk about all the great things you're doing and never be pressured or have someone go against you, I think it's hard to fail because people are going to keep throwing money at it. I mean, there's a lot of ETF families that do exactly what ARK does, by the way, for much longer with better results and better, in my opinion, management and less turnover of stocks. But what do I know? I'm not the one running ARK. She is.
But do they make their research public? Do they make their trades public?
Well, yeah. It's just she does it real time, but I think that's part of a marketing play. I don't believe that has anything to do with the value she's providing. I mean, think about Emmanuel. I want you I want you to think about something. Why is she doing that? Do you think?
Radical transparency.
Is it radical transparency, or is it so that then I jump in the next day and buy what she's buying?
I was on mute. I laughed so hard. I wish you guys heard it when he said radical transparency. I was dying when he said that. Damn, someone just said you're on mute. Yeah.
Yeah, Sean, you were saying, you think it's like a little fish hook?
Well, I mean, listen? Why do we invest? I'm asking this as a serious question. Why do people invest in ETFs?
So that they don't go like balls deep on one stock, but to diversify at the end of the day. It's a safer
option.
Sure.
To passively diversify your portfolio and access long-term growth in a structured fund, right? That's the fancy way to put it. Why do I want to be in an ETF that has turnover constantly, which means costs? Like, I want to be in an ETF where it's like, hey, I have predictable returns over time, passively can look at my portfolio once a month or even once a quarter, which is what really should be doing. And that's all I care about. I want to, over time, grow it. I want to have a family of them that maybe I invest in. I think we've gotten excited into today's world where it's like, I need to have a constant minute-by-minute update on an app of exactly how much money I've made today or lost today. And I need to know exactly what this, like, before Cathie, can you name me another person who runs an ETF?
No, to be honest, I think she made it popular, and she made it popular in the biggest bull market in the history of our world.
Well, I think number one, full transparency, there were not enough women running ETFs. This isn't, the fact that she's doing this is great. It's an amazing thing for this industry. This industry needs to change and diversify and have, it really does. And what she's done is great to have her face on TV and showing everyone has a place in this. But the problem becomes, this is supposed to be a passive investment for an investor who now has to follow her every move in fear of losing another 10% on their holdings. I mean, it just doesn't work for me as a holding.
Just the only pushback I got to give is that Amit, you showed the 5-year chart, right? So
Yeah.
if you actually bought into her 5-year thing and you would have bought 5 years ago from today, you would still have outperformed the S&P. So it's not her fault that it went up 10x and then down 9.5x.
I'm going to hold you right there. That chart didn't include dividend reinvestment, did it?
I don't think so.
Now, what if you were reinvesting all of those dividends the entire way?
Okay.
Right?
Oh.
Something to consider. I don't know if that did or didn't. But either way, I'm paying almost nothing for a management fee on SPY. I'm paying a lot to Cathie in comparison. Or even just a general like VTI, for example, where I can reinvest those dividends passively, hold it for 20 years, and never have to think twice. I'm not arguing with you. I'm just saying from my perspective.
No.
There's
Just
a
going
place
back
in
and
the
forth.
portfolio for it. It just seems very,
And Cathie became famous and she became so beloved because of Tesla. So if Tesla didn't do what it did, and with her persistence at the low times, then she wouldn't have become so famous and so beloved. But like, again, on CNBC, I always find they bring her on and be like, hey, let's bring on like the crazy contrarian lady. Cathie, tell us why.
Well, it drives views. It's clicks. I mean,
it's clicks. Yeah, it's views. Yeah.
I mean, like to quite frankly be honest, the new show I'm hosting with Money Talks. I mean, we put Cathie in the thumbnail the past couple of weeks. Like the click through rate is just better. So it's just like, man, it's just is what it is. Like,
Dude, Alex from ticker symbol U. I mean,
that
motherfucker,
bro. Every video. All right, we got to move on to another topic. We got 206 people in the chat. Thank you, 200 people being with us 12 a.m. on a Saturday night. Check out everyone's channel in the description. We've got something to talk about. You know what? We're going to keep the party going because why not? Elon Musk, baby. Next, I'm buying Coca-Cola to put the cocaine back in. Second most liked tweet in the history of our lifetimes. We are getting to witness this happen. Chris, I'm going to start off with you. Well, first of all, let me set it up. The deal looks like it's getting done. Elon sold 8.5 billion worth of shares to start getting this financing to happen. So, like, I think it's actually going to happen now because you don't sell 8 billion of your Tesla stock unless you're really going to get this done. A lot of people are scared when he owns Twitter. What's going to happen? A lot of the far left is worried that hate speech is going to increase on the platform. What are your raw thoughts on the Elon situation and what's going to happen with Twitter?
So a lot of people, when Donald Trump was saying all his stuff on Twitter, a lot of people said, oh, I'm going to leave Twitter forever. Okay, that didn't change anything. People came back on. The one thing that I think I'm very curious to really hear, and was leaked today, which was that Tesla, I need to stop thinking Tesla. Elon Musk actually did a presentation with the banks when he was asking for that money. And he said, listen, I'm actually going to treat this as a business, not just a platform for radical ideas to be put out there. So there is a business proposition that Elon put forward, right? And I don't think he would put out a business proposition to all these banks and hedge fund, banks without having a plan in mind. So I think there is definitely some value in Twitter. I don't know what it is, but the one thing I have seen is that Elon Musk is a radical operator, and he's been able to launch a lot of successful companies. I've never seen him turn around a company though. So let's see if he can do that, because this is, believe it or not, a turnaround story, because at this point you're going to try to figure out how to monetize a product that hasn't been successfully monetized yet. And the one thing I did like to hear was that he did say, I'm going to be focusing on compensation, because I always thought Twitter, and I said this on last time on our podcast, Twitter's compensation did not make sense to me. How the hell do you have so much money being paid out if you have this revenue of like $4 to $5 billion and you're paying out almost $4 to $5 billion? And like, dude, you are literally like managing a like a blogging service technically with 100 million or 200 million users at a time. Like that's all it really is. So I don't know where the technology improvements in Twitter have really like codified into additional revenue generation, but monetizing Twitter, I think that's what Elon sees. And I think that's, there is a value proposition that he sees. I don't see it, to be honest with you. I don't see it, but I'm not Elon Musk.
Sean, I want you to pitch your theory on why Elon's buying Twitter. And no one's heard. I don't think a lot of people have heard this one. This is the most radical take I've heard for why Elon's buying Twitter. So let's hear it. You're on mute. You're on mute, Sean. This is what they teach you at the library, bro. You're still on mute.
Can you unmute him? Like, is there
can
a way?
I unmute him? I can't unmute your guest because they chose
it's my connection keeps going down, so I'm getting like very pixelated on my end. Okay. I was gonna say I love that you're the fact that no one listens to me, so no one heard what I said on an hour-long show where I went deep into it. But you are right, by the way, no one did watch it. So here's the thing, right? Like, what's Elon's real goal? Is it to run Twitter, or is it to create self-driving cars, robots, AI that operates like a brain? And I think what he's pulling is an ex machina play with Twitter, real-time streaming data, human consciousness, and derivative meaning behind verbalized communication. I know this is the world I work in, by the way, so I'm a dork when it comes to AI, contrary to the Twitter battles I've been in the past couple of days. And it's an unbelievable amount of data. Everyone over here is dead on the money, by the way. If you want to build a brain, you need to access how all the other brains around are working, aggregate that information in real time, and stream it. Well, guess what? That's what Twitter is. Twitter is literally just an aggregation of thoughts in the moment that are reactionary, tied to events that are happening in real time, that allow you to think about the way people perceive and act on events, push their thoughts out publicly, then stream to a model that can aggregate, understand, and create insights from that. That's what AI level deep learning neural networks need to become intelligent at a next level. I'm not talking like Terminator silly, movie stuff here. What I'm saying is like taking AI deeper, taking deep learning deeper, getting neural networks that can learn in real time with data that has been hard to get. In years past, when I worked in social media analytics, we worked with human level AI approach. We were using Twitter streams. This is back in 2013, 14, and 15, okay? The problem was Twitter cut a lot of that off and became very expensive to get it or very hard to get it. He now has access to all of that. So good, bad, you hate it, you love it, it doesn't matter. My theory is he now has access to the world's streaming thought consciousness. I understand it's not everyone on the planet, but you get my point. It's streaming consciousness that he can then track, or a machine learning system can track to events. I'll give you a perfect example. Take the Ukraine war right now, right? A major crisis. Machine learning, technically though, Ultron did get beat, to be fair. So maybe Elon's actually, oh my God, he really is Iron Man. He's got Jarvis in the background. That's what that robot's going to be.
That would be wild. That would be wild.
I won't go into the details of it. I would love to, but I'll spare everyone at midnight. I just think that if you're trying to build next level intelligence, you now have access to data that no one else will have access to with live streaming APIs that you can feed into a system. That's pretty insane, pretty incredible, and honestly, it's brilliant if that's what it is. Maybe, perhaps it's not. Chris, to your point, is he buying Twitter to make a few bucks on ads? I don't think so.
So I'll just push back on your theory, Sean. I agree with what you said, but I don't think he would have bought Twitter if the censorship wasn't going on, and the final straw being the Babylon Bee getting censored. So what was he gonna do if the Babylon Bee didn't get censored?
I think that what he needed was a catalyst that could have a reason to buy the company.
So he's had this plan for a while?
I don't think it's a plan for a while necessarily, but I think that Elon's a smart, opportunistic. Chris nailed it a minute ago. Guys, I want to repeat what Chris said. Elon is an operator. An operator that executes the way he does is a lot more rare than people think. Everyone loves to hate on billionaires.
By the way, he thought about buying Twitter in 2017. He's tweeted about buying Twitter. So like this thought has been there for a while.
For sure. And I'm telling you, like a lot of large scale AI platform operators, like the IBMs of the world, the Googles of the world, etc., they're doing this already. It's just that Twitter is the best way to do it. Like being able to learn from a Google search is really good. Being able to learn from a Twitter feed, holy moly, that's unbelievable, right? Instead of my brain saying, hey, search what's happening in Ukraine, now it's getting, what do I think about what's happening? How do I react to what's happening? How did I learn and comment based on what's happening? It's a whole nother level of data analysis and data stream. And I think that this created a perfect example with a good following to have a reason that the board couldn't say no to. The price is down, the economy is down. He comes with an offer, whether people love it or hate it, I don't know, right? Whatever. I hate it because I had leaps in Twitter that now are freaking worthless, but that's a whole nother story. But that's my take on it. And you know what? I'm probably wrong. Let's be fair. I probably am wrong. But still pretty cool to think about, though, and might be something that's there, you know?
Here's a question that I just answer as honestly as you can. How often do you check your phone for Twitter compared to any of the other app? Like, do you check anything? I probably check Twitter at least once an hour, to be honest with you, because I have so many like things that are going on. I feel like Twitter gives me more information than and I have tons of people that I follow that I kind of want to know what's going on. So I find my 5 years ago, I barely ever used Twitter. Now I'm using it like every day, almost checking it every hour. And that's the question that I think a lot of us in this comment section should be asking, and put it down in your thing. Like, what about you guys? How often do you guys how often are you on Twitter?
What's your goal with this question?
My goal is to figure out.
Right, Ultron.
Yeah, my goal is to figure out, is Twitter becoming the next Facebook? You know, where at one point in time everyone was on Facebook for hours on end. Now I barely check my Facebook. What about you guys?
Listen, for me too, especially now, I'm getting more engaged in it. But my wife, ever since Elon just bought it, my wife like reactivated her account, and she's like, "Oh, I'm done with this. Forget it." She's like, "I don't even understand how it works anymore. I can't understand who's reading, who's replying." So it doesn't cater to everyone. It caters to us. We like it now. We're getting more engagement with other people. We're posting more. So it's not necessarily for everybody.
The thing about Twitter is, I think the only reason your question makes sense, Chris, and we all get it, is because we have a community on Twitter, which is us and a bunch of other people we know. I was on Twitter in 2013 in high school, believe it or not, and people were on Twitter. I was using it religiously. And then by the time I got to senior year, I stopped using it for the next 6 years. Then I went back on it over the past year. So like, I feel like if you're not in a community on Twitter, if you're just scrolling through random people's tweets, it's hard to get the value. Facebook is so stickier because it's your friends. It's a social graph. Like Twitter is not really as big of a social graph as it is of Facebook. And there's only 217 million MAUs. So when you say Twitter is the next Facebook, it's hard for me because unless you have a community on Twitter, like Emmanuel's wife, like she's not going to get anything from that service. But she'll get it from Facebook.
So my wife barely ever used Twitter in the past. And I accidentally logged into her account because she was logged into the computer. And I was like, man, all these pharmacists are just automatic, like adding me. I'm like, well, why are all these pharmacists adding me? And it was actually my wife's Twitter. So the thing is, like, I'm starting to see that happen. Now there's a lot of people that are disconnected from Facebook where they're looking for that sense of community ever since the pandemic started. And I think they're starting to find those communities in Twitter. So I don't know. You know, there was one tweet I saw, there was like Black Twitter, right? So there's a whole bunch of people that talk about Black issues on Twitter. Then there's us, Palantir Twitter. So all the people, there's FinTwit, but there's also smaller niche communities that are developed, like Palantir. Like I could name all of our Palantir folk. Like literally, we're at this point, we're a community, right? And I think that's what's happening. Some people are starting to discover Twitter is actually like an engine for things that you believe in, but you don't necessarily have too many.
Well, it's number
opinions
2 on
but
the
you
App
wanna
Store.
get-
Yeah,
Yeah.
now it's
Yeah.
bumped
What's
up.
number one?
Truth
Number
Social.
1 is Truth Social.
Boom.
Interesting.
Yeah.
I wanted to jump on something that Sean said. Sean, there was a leaked video I saw from Project Veritas when they were recording a Twitter employee, and I think it dates back a few years. And he was explaining that a tweet never gets deleted, and basically with all your likes and all your comments, they constructed like this type of digital twin of each person. So was that what you were sort of referring to?
Could you repeat that? I'm sorry. Maybe I misunderstood what you said.
So Project Veritas, they issued a video. They were undercover recording a Twitter employee. He was explaining that, even when you delete a tweet, nothing gets deleted. He goes, it's still in the database.
Oh,
and
yeah, sure.
And our database, he says, we basically constructed a profile of you. Like, we know who you are, what you like, and what you're gonna like. So a Twitter employee said that himself. Is that what you were referring to with some of your comments? Because even last time we spoke a couple weeks ago, you mentioned the same thing, that we're not in charge of what we like. We think we like what we like, but you were saying...
I think Sean's talking
Were you
about
aware of this
more
concept?
I think Sean's talking about a more global collective conscious. Right.
Yeah, Amit's right. That is what I am talking about. But like Chris and I both work in and around data at a very deep level. So Chris, I don't want to speak on your behalf here, but like you might be deleting what is publicly being seen, but those keystrokes that it's called event monitoring. Okay. Event monitoring is when within a server or a system of servers, every single keystroke, motion, thing that you've done, it is being recorded for analysis later on. Now, I wouldn't confuse that with like they're going to read the tweet that you deleted. It's more about the metadata layer, the data about data. But there's a lot to be learned there. So like the insights might be like, hey, why did you delete this tweet, right? And how many people are deleting tweets? Maybe we got to offer a new product feature to not allow that to happen, right? I don't think this idea of like digital twins is what I'm getting at. I just think it's more like a streaming collective of information, separated out from what you're thinking. It's not. I don't have it connected to that. Is my thought process there.
Twitter becoming the next. I mean, if Twitter does become the next Facebook, maybe Elon's the one to take it to that promised land at the end of the day.
Yeah, and
Look,
I
Mick,
wonder
can you
what
give me the
other
context?
features. I'm sorry.
Go ahead. No, go, Chris. Go ahead.
No, I wonder what other features that Elon is cooking up in his brain, right? Because I'm sure that he's not going to just leave it the way it is right now. I'm sure he's going to add features to it to
You think he's
figure
gonna
out
be the
how to
CEO?
make it bigger. Yeah, I think so.
You think he's gonna be the CEO of Twitter?
Or he'll be the chairman of the board for it. There's only 3 real positions that actually matter in any company. One is CEO or COO to run the company. Then you have the chairman of the board, and then like a president. Or a president, and that's about it. There's not very many like positions.
I think he's gonna call
that are
himself
out there.
Chief Meme Lord or something. Like I wouldn't put it past him to do that. I really wouldn't.
Yeah, I
Put a
mean,
robot
what's
in
his
charge.
name? Jack Dorsey's calling himself the blockhead now. He's like the head of block,
saw
so he's
that,
the
yeah.
blockhead. Yeah, So I think he'll play a meaningful role in it initially, and then get a really good operator to run day to day. That's what one of the things about Elon is that he knows how to grab talent and put them in the right place, and then the talent usually takes care of a lot of things. Like look at Boring Company. You think Elon Musk is calling, like literally going to Boring Company all day long, or Tesla all day long? No, he finds people that he believes in that can do the job, gives them the autonomy to do the job, and just follows up with them when he has to, and that's about it.
Yeah.
Mitt, I was going to say before, can you give me the 2017 context when you said Elon said that he was going to buy it?
Elon said, "I love Twitter." Someone said, "You should buy it," and then Elon responded, "How much is it?" That was the thread. It was a 3-tweet thread. I mean, he's loved the product. The guy like loves the product. Like the guy responds. He's engaged. I mean, it's kind of crazy. Sometimes he goes on these rants, and it's like 5 p.m. It's like, bro, aren't you like at the factory? Or something? Are you just on Twitter? Like,
Dude, there's news that is based on events on Twitter. Like my Google feed right now is Elon Musk gets to spat with AOC. Like that is on the headline right there. So Donald Trump did the same exact thing. Donald Trump said he's gonna go, nuke North Korea tomorrow, and that was like on every major headline. I mean, imagine the power of something like that. A tweet, literally like 15 character, like I don't know how many characters the limit. What's the character? I don't know.
280.
280 character limit, and you can change the world with it. you know.
That's just the beautiful power of this platform. I mean, for all the shit Twitter gets, it's like, as Sean said, it's a collective consciousness of everyone contributing at one moment, and you can sell shit when there's a lot of people there. You can build a brand. You can, people have done amazing things because they just have an audience that they can send one tweet to for their Shopify link, and then people start buying their t-shirts. I mean, like, to me, it's the greatest time to be alive to actually build an audience. And there's an algorithm that gets you discovered. All of us are ranking and getting more followers because we're talking about things that we know our community cares about, and we're giving our unique spin. And it'll be interesting to see if Elon does something like monetize tweets where we get 0.00001 Doge for every tweet. I mean, it's interesting to see what can happen. All right, that is it. We topped out at I think 215 people. We got the Ferrari hat.
Nice. I saw someone post it way earlier in the chat, so I want to give him credit, but I don't remember who did it. They said Emmanuel Leclerc. I was like, oh, nailed it.
Dude, why would you get a black hat, man? Why would you get a red hat? Like,
it's it's brown and it's leather. So.
It's brown. Okay, gotcha. Nah, I'm ordering a Ferrari one too, but it's actually going to be red. It was either that or a jacket. Yeah.
I'm just going to buy a Ferrari. Forget the hats.
Yeah, Sean's like, fuck you guys. I'm just buying the Ferrari.
I won't fit in a Ferrari. That's the main problem I'm having right now.
Midlife crisis incoming.
So it is amazing that it was a Palantir weekly review. We didn't really talk about any Palantir news this week, but that shows that I think we're getting better as communicators because we got 200 people to listen to us talk about all this other stuff other than Palantir. Look, Apollo came out. It was a demo day. I mean, we're talking to Coach Rap next week. Sean, you're welcome to join. Man, you're welcome to join again. We'll go deep into Apollo. He can probably explain it better than a lot of us. They didn't really do a demo day. That was the thing that was a little weird. It was just a YouTube video. It wasn't like it's kind of weird. It's like, yeah. They were hyped. They had you register for this event. It's like, motherfucker, it's a YouTube video. Like, just post it. The fuck you mean? I think it was marketing.
They got the emails. They got the emails of potential clients, right?
It was a little clickbait.
Yeah. Did you see Jay's response to that? That was hilarious, dude. Jay from Palantir. He lost subscribers because of it.
Oh, so what did he write exactly? What did he write?
I think he made a video just ranting about how it wasn't a demo day and they clickbaited and all this stuff.
Oh shit.
But yeah, I mean, they had an Apollo video, and nothing. No, there was no other really crazy news about Palantir.
Well, Coach Trap did the video with the chief architect.
Right,
that came out later that day, right?
Everyone check out. Yep.
Yeah.
I think a lot of the new videos that Coach Trap's been doing with like demonstrating Palantir are amazing. Anyone who's actually in data engineering, data science, they're starting to see it and be like, "Wow, that's kind of crazy." Like I'm very impressed by one of their products called Quiver. That I'm like, wow, that's actually something that I'd love to use, So it's starting to get out there. I think Coach Trap is really providing a good value to Palantir. Yeah. I hope they're I don't know how they're compensating him, but I hope they compensate him.
Stock-based comp, baby. Dilute the shareholders. That's what we got to do. We got to deal with it, right?
No, I don't think he's getting like compensated
like that. I don't think he's getting equity.
No, but the thing is like. He definitely is like an evangelist. I think I said in the comments in one of the videos, like Coach Trap is like the Sandy Monroe of Palantir because it's like Sandy Monroe, right? Sandy Monroe, when it came to Tesla, used to actually break Tesla down and actually analyze it and say, wow, this is a really good product because X, Y, and Z. Coach Trap is actually doing the same thing. So I think someone said Tom Lee, that he was Tom Lee or something. I don't know who Tom Lee is, so.
Tom Lee's the guy who's always bullish on CNBC. You know Tom Lee? I'll send a clip. You know who Tom Lee is. I'll send it.
Yeah.
All right. I think we're out. Anyone have any closing thoughts? We're good? Everyone's good? All right. Everyone check out everyone's channel in the description. 170 people. Thank you guys for being here. We will see you next week. Enjoy your week, everybody.
Peace. Thanks, guys.
Bye, guys.
Ciao, ciao.